The Federal Reserve just cut interest rates by 25 basis points, and everybody is assuming that the market is going to rip. But for those of you guys that have been around here for a little bit, know that I've been very skeptical on this. We're going to dive into all of it. But first, we need to dive into the real meaning behind this 25 basis point cut. And we'll dive in and dissect a little bit of what Jerome Powell had to say about the next potential cut that we could be seeing here in the interim. But first, let's check in and see how the S&P 500 is reacting based on this cut. Of course, we've got the 1 day. We're starting off a little bit lower at 0.4% down today. But the reality is that Powell raised doubts about easing at the next meeting, which I think is more significant than what actually happened at this rate cut decision, where he talked about cutting potentially not next time in December, but maybe holding off on that in a little bit. And to be honest, I think that potentially could be the right move, but it wouldn't be the right move for markets. And let me explain why. Because I think that the markets have already priced in 3 rate cuts for this entire calendar year. So that would include the rate cut that previous happened, the rate cut that we just saw now, and one more coming in December. Now, the reason I think that that's already been priced in is, well, I mean, the markets have been screaming for these cuts for quite some time. You can look at the bond market. You can look at all the other signs, the signs from the stock market, and they're always showing that it seems like these rate cuts are priced in. But now that Powell has raised doubts, and it looks like we aren't going to be cutting that 50 basis points that potentially was on the table before, now it looks like the Federal Reserve will be in a little bit more of a hairy position. By a 10-2 vote, the central bank's Federal Open Market Committee lowered its benchmark to 3.75 to 4%. So this rate move announced that it would be ending the reduction of asset prices. Now, this is what's interesting, right? That the markets are still overpricing Fed cuts. Markets expect too many Fed cuts despite Jerome Powell's caution on all of this. And that's where I think things are getting interesting, is because Jerome Powell has been very cautionary when talking about these Federal Reserve interest rate cuts and the potential of these here going forward. And he's been very cautious with this because he wants to see the data. And he's come out and said, there's a sense for some, let's pause. Could imagine that the lack of data with the government shutdowns affects the December decision, right? So another cut in December is far from assured. Shutdown will temporarily weigh on economic activity. Available data suggests that the outlook hasn't changed much. So all of this is just basically pointing to this right here, is that the Fed is or the markets are already pricing in 3 rate cuts. But because of this government shutdown, well, we don't know necessarily if that the data is going to be pointing to all of this, right? Because we might not even receive any of that data. And so the Fed cutting interest rates by a 10-2 vote, the central bank showing this, right? Some of them have been calling for a 50 basis point cut, and we just simply haven't gotten it. So this rate that's also set the benchmark for a variety of consumer products such as auto loans, mortgage, credit cards. The post-meeting statement did not provide any direction from the committee's plan for December, as the September meeting officials indicated that the likelihood of 3 cuts this year, the Fed meets once more in December, and they've cautioned against assuming that a rate cut is a sure thing, right? Because this guy, Jerome Powell, has essentially just slowed it all down. He's pumping the brakes on everybody, saying, hey, you know what? This could be my Volcker moment, because for those of you guys that keep coming around, please hit that subscription button. We've passed 400, so thank you very much for everybody that already is subscribed, but 92% of you guys aren't. And I've been covering this for a while on how Jerome Powell and Donald Trump are essentially butting heads with all of this, right? So because these guys are butting heads and because these guys are just not getting along, well, Jerome Powell knows he's on the way out come May. He doesn't want this position any longer. And God bless the man, because I think it would be very difficult to hold this. But either way, right? The future of what we're seeing, it's not locked in, because inflation is still there. If you look at CPI, PPI, all the metrics, right? The cut of a quarter point is not necessarily locked in, right? So another December cut with financial markets largely expected. Stock prices dropped after Powell's comments, and with the S&P 500 nearly unchanged, the Dow Jones Industrial Average closes slightly lower yet again, because Powell poured cold water on the idea that the Fed was on autopilot for this. But what's interesting is if you look at the odds here from the CME group, right, they've put an 88.2% chance that this Fed is going to cut rates. But of course, that's in 41 days. So we're recording this on Thursday, October 30th. We still got until December. So we've got more than a month in until this next decision. And like everybody is saying here, it's not necessarily priced in with all of this. And, we have Goldman Sachs and others hinting at the fact that there's a potentially a low chance of a recession here soon, because they're all saying, oh, the economy is in good shape. This is what the narrative of TradFi is that the economy is perfectly fine. But if you take a step back and look at it, right, the CPI, the PPI, the PCE, all of these numbers are still stagnant and floating around that 3% rate. So the Fed's initial target was 2%, and they've changed that. They've changed that over time. And why have they done that? Well, they've done it because they believe that they don't really necessarily need to hit that 2% rate, because it was all just a figment of our imagination, right? Everything that the Fed does, the fiat life, it's all just one big mirage, one big giant illusion. So it's interesting when you really dig into these numbers and you see, okay, there really isn't a ton here, right? The Fed's decisions, well, we aren't going to see billions of dollars get rolled out. This was essentially just a shoe-in, and we needed to see this, right? And everybody was looking at, how is this going to affect the market? We've had such an AI boom, and this is what we need to continue to see, this AI boom go through. But the reality is like I said, these were already cut, these were already priced in. The one benefit that we are going to see from all of this, though, is mortgage rates dropping. This is one thing that we need to do, is save the housing market, because the housing market isn't as liquid as the S&P 500. It doesn't change as quickly, and we've seen the housing market essentially be bleeding out here recently. The housing market hasn't looked good at all. The housing market actually has been extremely poor, if you ask me. And so because the housing market has not been good, we need to drop these interest rates, because 60% of all mortgages are now under 4%. Now, look, I'm not saying we need to get to that low, but to tempt somebody to go from a 4%, 3%, even less than 3% mortgage to now a 6.17% mortgage, it seems absolutely insane. So the Fed cutting rates, everybody was assuming, the market is going to absolutely explode. Not so fast, my friend. I think the opposite. I think that this has all been priced in already. And, you actually look at, after Powell's words, the Dixie is actually roaring back and having a good positive turn here. And this is something that we need to be keeping a close eye on, because the Dixie needs to come up. And so seeing the Dixie shoot up to 99.5, hopefully we can crack that 100 mark. We got very close earlier today. It looks like we got at 99.7, maybe 99.8. And so, that is something that I think we need to be really looking at. And hopefully we can continue to see that price up because, even though we've got an 88% chance, I don't necessarily think that we need to cut interest rates here going forward. In my opinion, I think it would actually be better if Donald Trump doesn't push the gas on this because I think that inflation where we've got, I think if we have the stronger economy in America compared to all of the other interest rates environments and all the other fiat currencies. So let everybody else cut first. Let them open the floodgates and that liquidity will get dumped into the United States. And so while everybody else is dumping liquidity into the United States because we are the best performing stock market, you unleash all of that. Well, then everybody else's fiat currency devalues against the United States. And that's why you're seeing the Dixie start to shoot up now, just as an aside. So I think that we need to keep on keeping the foot on the gas here. And so I'll be keeping a very close eye on this. Make sure you guys are smoking that like, hitting that subscribe button for me with the bell notification so you could join the chat, telling a friend to tell a friend, and I'll catch you guys all at the next one.